There's a line from the movie Moneyball that perfectly captures the trap many community bank CEOs fall into. If we play like the Yankees in here, we will lose to the Yankees out there. Most CEOs measure their bank the same way everyone else does: call report metrics, peer comparisons, ROA, efficiency ratio. But the question, what is my bank worth, assumes the buyer is using the same scorecard. They aren't. While you're looking in the rearview mirror at what you've built, buyers are looking out the front window at what they can do with what you've built. It's a completely different game. And if you don't understand the game, you don't control the outcome. If you're a CEO, CFO, or board member, this matters because understanding how buyers actually think about value changes how you build value today, whether you ever sell or not. And before you think this is about deciding to sell, it's not. This is about understanding how value works from a buyer's perspective, so you can lead with clarity. This isn't sale prep. This is strategic positioning. I'm Knutson. I founded and led a community bank as CEO and chairman. I've navigated the same strategic decisions you face: raising capital, building teams, developing leadership, and growing a bank customers proudly called their bank. I've been in your seat through every phase of a bank's life cycle. That perspective is what you'll hear every episode. Here's the mental trap most CEOs fall into. When you think about strategic options, the natural frame is, what do I have and what do I get for it? That's how bankers are trained to think. We look backward. We analyze what's been proven. We value predictability. Cash flow repays loans. History reduces risk. But equity investors and strategic buyers are paid to look forward. They're asking different questions. What does this business become when combined with ours? What future cash flows can we create together? What optionality does this give us? Until the transaction closes, the seller still has future outcomes at stake, which means the hardest work isn't looking backward, it's thinking about the buyer's future with your bank as a part of it. I'm not saying you should sell. I'm saying this: understanding how buyers see your bank changes how you build your bank. The banks that command premiums aren't the ones scrambling when someone knocks. They're the ones that built strategic value all along in ways buyers could immediately recognize. That understanding creates optionality. So let's get specific. What actually drives value in a buyer's eyes? There are 8 drivers, and they fall into 2 categories: the foundation and the differentiators. The foundation gets you invited to the dance. The differentiators determine who's competing to dance with you. Let's start with the foundation. Foundation driver 1, financial performance. This is the most important baseline driver, not just earnings, but the quality, consistency, and predictability of those earnings. Buyers care about core earnings, not one-time gains, not noise. Stable or steadily growing core earnings create more value than almost anything else. What detracts? Non-core income, one-time gains, large transaction costs buried in contracts. Credit quality matters, but it's expected. It protects value, it doesn't create premiums. Financial performance gets you in the conversation, it doesn't win it. Foundation driver 2, growth potential. Buyers aren't looking at what you've built, they're looking at what they can do with it. Growth potential means strategic opportunity, market expansion, scalable platforms, core loan and deposit growth, predictable, repeatable, relationship-based. Non-core growth, wholesale funding, bought relationships, detracts. If anyone could buy it, it's not strategic. Foundation driver 3, diversification. Diversification reduces buyer risk. Earnings, customers, leadership. Concentration introduces fragility. Balanced institutions signal resilience and scalability, and buyers pay more for that confidence. Foundation driver 4, recurring revenue. Recurring fee-based revenue smooths volatility. It reduces dependence on rate cycles. It signals foresight. It stabilizes valuation. Together, these four drivers establish baseline value. They determine whether you're even in the conversation. This is where banks stop being comparable and start being chosen. Now let's talk about the differentiators. Differentiator 1, niche. Sameness erodes value. Niche creates leverage. A defined market, a specialized customer, a delivery model others can't replicate. Your uniqueness isn't a liability, it's your advantage if you understand it. Differentiator 2, customer satisfaction. Loyal customers reduce integration risk. Measured satisfaction signals discipline. Retention stabilizes earnings. Trust survives transitions. Buyers value evidence, not anecdotes. Differentiator 3, leadership independence. This is where many banks lose value. Buyers hesitate when leadership retires at closing. They don't know your people. They don't know your culture. They don't know your market. We saw this early. We developed leadership long before any transaction, not as sale prep, but as strategy. By the time we sold, our management team, excluding me and our president, averaged under 40. That wasn't coincidence. That was optionality. Leadership independence exists when the institution is bigger than any one person. Differentiator 4, timing and readiness. Timing determines leverage. Ready banks control the process. Unprepared banks react. Governance, contracts, alignment. Readiness converts vulnerability into a strength. So here's the full picture. The foundation: financial performance, growth potential, diversification, recurring revenue. The differentiators: niche, customer satisfaction, leadership independence, timing and readiness. The foundation establishes value. The differentiators create premiums. But understanding the drivers is only half of the equation. The other half is how they combine and when. That's strategic value. This isn't about selling. It's about understanding your strategic position. When you see value the way buyers do, you make different decisions about people, about technology, about growth, about risk. We discovered this by reverse engineering our own acquisition strategy. The banks we wanted to buy looked a lot like the bank that eventually bought us. That insight changed everything. Understanding creates optionality. Today, you didn't just hear 8 value drivers. You got a different lens. Stop looking backward at what you built and start understanding what buyers see looking forward. That shift changes how you lead. Next episode, we'll explore how these drivers combine. The 2 + 2 = 5 equation that separates average outcomes from exceptional ones. If you're new to the Community Bank Value Playbook, I've created a new listener resource guide to help you get oriented. You'll find it linked in the show notes. And remember, the best decisions come from knowing all your options.